Welcome back to the Talking Hedge. I'm Josh Kincaid, and this is your Cannabis Business Podcast. Today, we've got Katrina Glogowski. She's an attorney and angel investor. We're going to be talking about how to invest in cannabis stocks, thinking like a banker with 5 tips to avoid fraud. Katrina, thanks for being back on the podcast.
Morning, Josh.
So we understand that this is a multi-billion-dollar industry. The Safe Banking Act is going into play, and so there's a lot of opportunities at the end of 2019, rolling out 2020. And so looking at 5 things to consider in order to avoid fraud, you got to think like a banker. So when considering an investment opportunity, bankers employ a common concept in the industry known as the 5 C's, which is a framework to group risk and responses when considering investment proposals. These topics sometimes differ according to industries, but for investing and considering credit risk, the 5 C's consist of character, capacity or cash flow, capital, collateral, and conditions. So starting with character, even if you think you're participating in a safe business arrangement with trusted friends, it's crucial to verify the backgrounds of individuals and entities managing your investment. Indeed, marijuana is still illegal at the federal level. Many individuals in the business have questionable intentions.
Josh, this is actually common in the angel investment world. People will invest in the CEO or the inventor of the product, and they make investment decisions based on that particular individual. So this is common in the industry. Call it character, call it personality, call it potential for that specific individual. But I've seen this before. This is common, Josh.
Yeah, on our weekly segment we have 7 tips to a successful or engaging pitch deck. And the one thing that we have that's consistent, I think is number 6 on the list, which is having a team. And so if you don't have that team set, then that you're lacking that character, that development, that enticing aspect that's going to draw people in, because everyone has an idea, everyone can envision that new concept. But if you don't have the realistic human capital, that capacity to put mechanisms in place to achieve goals, then you're gonna go nowhere. You're just gonna have a dream. And we've seen a lot of individuals, entrepreneurs, place roadblocks in front of themselves. Founder syndrome is real. And if you can't get out of your own way and delegate and hire a team, then you could just go to the wayside and be obsolete before you even know you're irrelevant.
Correct.
So number 2 is looking at capacity and cash flow. So this article goes on to say that, will the entity you're interested in having the cash flow to repay the debt? Any business deal or investment requires due diligence. So request bank statements, profit and loss, any other financial records that give you a better understanding of the debt to income ratio of the companies requesting your investment dollars. We've seen a lot of LOI companies. I am not a fan of a letter of intent. If you have a letter that says you plan on doing business, guess what? You're not in business. So stop asking for an allowance from your mom when you should be out getting a job. I know that sounds harsh, but I'm tired of LOIs. They're a tool in this industry to manipulate people who are speculative and desperate.
Agreed. Again, I would call this proof of concept. Even if you have one customer or $1,000 worth of sales, I want to see that you have an actual business. I want to see a product. I want to see a sale. I want to see a distribution agreement to get you into Walgreens with your CBD face cream. I want to make sure it's real. And that is very important. Proof of concept is imperative. And an LOI isn't proof of concept.
Capital is real. It's not a visible unicorn. It's something that you're going to need. We've talked about a war chest on this podcast before with producers in Washington State, spending $1 million literally on property, plant, and equipment and not being able to grow or sell a single gram. They could grow it, but then it's filled with spider mites and mold, and nobody ever wants to do anything with that. Right. So with capital, they ask about how much money does a borrower have. Check any representations that they make against documents that they've provided to you. Take a closer look to confirm those statements are true. I think even if they do have capital, take a look at some of the market caps on these companies, with MedMen buying at what's probably the peak price for commercial real estate in the history of real estate. outside of Tokyo in the 80s, we're looking at some really speculative commercial real estate, and it's only going to take a small fraction of a correction to make something like MedMen have to go through a bankruptcy proceeding to stay alive.
Right. And so in the angel community, we do look at funds. Where are the funds coming from? Do you have a big name investor? Do you have a venture capital fund? Have you gone through an accelerator? Not just I have $10,000 in the bank. Where'd that $10,000 come from? Is that a loan from your mom, which is valid? That's okay. Everybody starts with something, but we would be looking at where the money is coming from. There's also individuals in the angel community that want to see the entrepreneur doubling down, betting on themselves. How much money of your own funds did you put in this business? Then that weeds out the CEOs for hire and this type of stuff. It demonstrates a commitment when the individual entrepreneur has put money in. And then when you start collecting outside money, maybe you've heard the term lead investor. So who is putting the money in? So not just I have money in the bank, where did it come from? Capital is important.
100%. And so is collateral. So sometimes companies requesting investment dollars will offer collateral to assure repayment of the investment. But if the collateral already has a lien on it, you may need to wait in line to receive nothing in the event that investment goes south. I think there's no better example than WeWork. We saw $47 billion market valuation on WeWork. And if you look at Regis, which is a competitor, you'll notice some really kind of frightening differences, I guess. And so Regis is the same thing as WeWork. They've been around longer. They have more of a global square footage, more members, like 25 million versus 500,000. They have more locations. I'm talking about 3,000 versus just over 500. They're in 4 or 5 times more countries. Their revenue is 34 billion versus 1.8. And they have a profit, not a loss. And yet Regis's valuation is 3.7 billion compared to WeWork's 47 billion. So when you're talking about collateral, SoftBank went out, gave WeWork way too much money with no oversight. WeWork went out and bought 16 properties in Hong Kong, which has some of the highest rates out there. There's literally a daycare in New York City under WeWork. And so, I mean, they went off the deep end with their investments, especially with collateral, because like I mentioned, any kind of retracement or correction, recession, whatever, is going to make this company insolvent in a matter of minutes.
WeWork is a classic example of growing too big, too fast, without a lot of analysis related to that growth. I think it was a good concept. Regis most certainly was first. But Regis grew correctly. WeWork just off the rails, couldn't buy fast enough. And you see now the consequences of that. For an angel investor, though, Josh, collateral is rare. When you come in a friends and family round or a seed round, very often they have a prototype of a machine that may or may not be able to be replicated, and very little cash. So for an angel investor, collateral isn't imperative. It's always nice. Hey, I have a building already that makes it attractive. I like those things. But for an angel investor, collateral is a bonus point as opposed to a requirement. So that's good if you have it, but not necessarily required at the angel level.
No, and there's an example where I had a joint rolling machine as collateral, actually a blunt rolling machine. And I went to some of the tribes here in Washington State for a tribal tokenized asset using blockchain and cryptocurrencies with a blunt rolling machine as collateral. But when you bring a deal like that in a burgeoning or nascent industry, you have to be very simplistic and straightforward. And when you're talking about tobacco regulations on top of cannabis regulations, on top of tribal regulations, on top of crypto, that was complicated. And you just saw the glaze in their eyes, and it wasn't from being stoned. So even if you do have collateral, streamline it, make it simple.
Keep it simple, stupid.
And so that's maybe where conditions come in at. Finally, look at the governing documents closely to determine how you will be paid. Do the terms of the investment allow the borrowers to pay you whether they want to pay you? Is there a specific percentage that you're supposed to get? And what does the resolution clause say about arbitration? So the words that might be spoken among the best friends in an investment deal may be disregarded by a court reviewing the words actually written in the investment contract. So understand the written documents well. There's a lot of ways to kind of get out of this. And I think right now we're kind of starting to see some people get into the industry because they can, because it's a TINA market. There is no alternative. TINA stands for there is no alternative market. There's a lot of things crashing. Automotive industries crashing. The bond market's not really doing well. Stock market's at an all-time high, which is giving investors, an indication that maybe things are going to crack and come to a downside. And so all of that asset reallocation is kind of coming into alternatives like vices, right? Anytime there's a downturn, you're looking at tobacco, cannabis, alcohol, and defensive stocks. So sin stocks will have an upturn. And so when you have all of these speculators coming in, you should really be looking at the fine print instead of rushing in out of FOMO, instead of logically looking at the terms and conditions.
Absolutely. An angel investor absolutely, positively must conduct due diligence. When you start signing papers, or do you have preferred stock? Can you be voted out? What are you going to do with this stock? What are your rights related to the company? When the company goes south, are you on the license? And what are the implications of that? You really, really need to pay attention to the documents. If you don't understand the documents, hire a lawyer, because you're putting your money on the line. And one of the reasons for accredited investors or qualified client requirements from the SEC is you basically, as soon as you invest in a startup, that money's gone. There is nobody who's going to buy you out. There is no stock that exchange you can list it on to sell it. And so that's one of the reasons why accredited investors are so important to a startup. I can afford to lose the money. I don't want to lose the money, but you basically got to kiss it goodbye. And that you can hope, you can pray, you can certainly work hard to turn it around and do those types of things. But those conditions really need to be examined, because what are you going to do when it goes south? Most startups fail. Most of them do.
And the word guarantee is also illegal with that regards. You cannot offer a return or a guarantee at all.
No.
Or otherwise, that would be fraud.
Well, 5 tips to avoid fraud. When you see guarantee, that's a red flag.
Run. Well, I think that about wraps this up. This is Katrina Glogowski. She is an attorney. She is an angel investor. I want to thank you again for being on the podcast. With that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't. And I'm out.